You buy a plot of land near a highway exit. You install a few fast chargers. Electric vehicles are multiplying every year, so drivers show up, plug in, pay for electricity, and drive off. The station just sits there, generating income, the same way a gas station has for a century. That's the pitch you'll find in almost every How to Start an EV Charging Business video online. It's also, for the vast majority of people who try it, wrong.
Not wrong because EVs aren't growing. They are. Wrong because the business underneath the charging station doesn't actually resemble a gas station at all. It resembles something closer to owning a small power plant that happens to have a credit card reader attached to it. And that difference is exactly where the money disappears. To understand why, you have to start with a question almost nobody asks. What is a charging station actually selling? It isn't selling electricity. Not really.
Electricity is a commodity. It's cheap, it's everywhere, and almost every building in America is already connected to it. If a charging station were only selling electricity, the margins would be enormous, because a kilowatt hour bought from the grid and resold to a driver should be a fairly simple markup business.
What a fast charging station is actually selling is speed on demand. A driver doesn't want electricity sitting in a battery somewhere overnight. They want 200 miles of range in 20 minutes right now at a specific location on their route. That requirement, instant, high-power delivery, available at unpredictable moments, is what turns a simple commodity into an infrastructure problem. And infrastructure problems are expensive in a very particular way. The cost isn't in what you use, it's in what you're capable of delivering, whether you use it or not.
That distinction sounds abstract. It isn't. It's the single biggest reason charging stations fail financially, and it comes down to one line item almost no first-time owner budgets for correctly: the demand charge.
Here's how utility billing actually works for a commercial site, like a fast charging station. You're not just billed for the electricity you consume over the month, the energy charge. You're also billed for the single highest burst of power you pulled from the grid at any point during that billing period, the demand charge. Utilities charge this because they have to build and maintain enough capacity, substations, transformers, wiring, to handle your peak draw at any moment, even if that peak only happens for 10 minutes a month.
A fast charger delivering real-world road trip speeds can pull somewhere around 150 kilowatts for a single car. Multiply that by several chargers running at once during a busy afternoon, and a station can spike to demand levels usually associated with a mid-sized commercial building for the same amount of monthly energy use as a modest retail shop. Industry researchers studying utility tariffs have found that at today's charging volumes, demand charges alone can make the fast charging station unprofitable, because the station is being billed like it's constantly near its peak capacity, even when it sits mostly empty. One widely cited estimate is that a single fast charging session a day at a highway standard station can already trigger a demand charge equivalent to 150 kilowatts of billed capacity. The kind of number a station might only reach a handful of times a month, but pays for as if it happened constantly.
This is why a station can be doing exactly what it was built to do, charging cars quickly, and still lose money on the electricity bill alone. The faster the charger, the worse this problem gets, because speed is precisely what spikes the demand charge. The station's biggest selling point is also its biggest financial liability. And that's before you've paid for anything else. Building the thing costs more than people expect, and the charger is the cheap part.
Ask someone who's never built a station what a fast charger costs, and they'll usually guess a number in the tens of thousands, and they'd be right as far as the charging unit itself goes. Hardware for a single DC fast charger typically runs somewhere in the range of $30,000 to $90,000, depending on power output.
But the charger cabinet is rarely the expensive part. Getting enough electrical capacity to that cabinet is. Most commercial sites were never wired for the kind of power draw fast charging requires, which means a new transformer, upgraded switchgear,
trenching, permitting, and sometimes a request to the utility for a service upgrade that can take months or years to schedule. Once all of that is included, a single DC fast charging port, fully installed, commonly lands somewhere between $90,000 and $250,000, and high-power sites needing dedicated substations or battery storage can go well beyond that. On a typical project, the electrical and civil work, not the hardware, makes up the majority of the bill.
That means a modest 4-port fast charging station, the kind you'd see off a highway exit, can represent a capital investment well into 7 figures before a single car has plugged in. Compare that to a traditional gas station, where the underground tanks and pumps are a known, standardized cost, with decades of predictable installation practice behind them. A charging station's price tag depends heavily on how far the nearest adequate power line happens to be, something the owner often doesn't fully know until the utility survey comes back. So now you have a site that costs 7 figures to build, and a billing structure that punishes it for being used in short, powerful bursts. The only way this math works is volume, a steady, reliable stream of cars charging throughout the day, spreading that fixed cost and that demand charge across as many paying sessions as possible. Which brings us to the metric that quietly separates a working station from a failing one. A busy-looking station can still be a losing station.
Picture 2 stations. One has cars parked at it constantly, busy in every photo, always mentioned in local reviews as the go-to spot. The other looks quieter, cars coming and going in more scattered fashion. Intuitively, you'd assume the first station is doing better.
Not necessarily. What actually determines profitability isn't how full the parking spots look. It's utilization, measured in minutes of active, paid charging per port per day, spread evenly across as many hours as possible. A station can look constantly occupied because chargers are slow, because cars are parked there long after they've finished charging, or because only 2 of 6 ports actually work reliably, and still be delivering far less billable electricity than a quieter-looking station where every charger cycles through customers efficiently all day long. The photograph tells you about parking. It tells you almost nothing about revenue. This is where EVs are still a genuinely small fraction of vehicles on the road matters. Even in markets with fast-growing EV adoption, most fast chargers spend the overwhelming majority of each day sitting idle, waiting for the next car. Low utilization is normal for the industry right now, not a sign that a particular operator did something wrong. But low utilization combined with a demand charge billing structure is a specific, predictable trap, and it's worth walking through exactly how it plays out, because this is the chain reaction that has quietly wrecked far more stations than any single bad decision could. Here's how one weak link becomes a collapse. It starts with low utilization, not enough cars charging throughout the day to spread out the fixed costs. That low utilization means each charging session that does happen has to absorb a larger share of the site's demand charges and lease payments, which pushes the effective cost per session higher than the owner budgeted for. To protect margin, the price per kilowatt hour goes up, or maintenance spending quietly gets deferred. A broken screen doesn't get fixed immediately. A malfunctioning port gets taken offline instead of repaired that week. Reliability starts slipping. Here's how one weak link becomes a collapse. Drivers notice reliability before they notice anything else. EV charging apps and driver communities actively track and share which stations are unreliable, and a reputation for broken chargers spreads fast. Because a driver who arrives with 8% battery and finds a broken charger doesn't file a polite complaint. They route around that station permanently and tell other drivers to do the same. That drives utilization down further. Lower utilization pushes the per-session cost up again. The cycle feeds itself. This exact pattern has played out publicly. Reporting on one of the country's largest fast-charging networks found persistent complaints about broken or unreliable chargers, undermining trust in the entire system, even as the company kept expanding its physical footprint. Building more chargers doesn't fix a reliability spiral. It can actually make it worse, because it spreads a fixed maintenance budget across an even larger number of ports. Which raises an uncomfortable question. If the economics are this punishing, why do so many companies keep building anyway? The answer is the counterintuitive part. The driver plugging in isn't always the real customer. In a lot of gas stations, the person buying fuel is the entire business model. In a lot of EV charging stations, that driver is closer to a supporting character.
Automakers need charging infrastructure to exist so that people will buy electric vehicles in the first place. Range anxiety is a sales problem long before it's a driving problem. Real estate owners want chargers on their property because it draws in a demographic that tends to spend more time and more money at the attached retail or restaurant while their car charges. Governments want charging infrastructure built out because it's a prerequisite for broader EV adoption targets, and they've been willing to pay for a meaningful share of the build-out through grants and tax credits to make that happen.
That reshapes who the station is really built to satisfy. A retailer might accept a barely profitable, even loss-making charging station because the real payoff is the extra foot traffic and dwell time in the attached store. A government program might fund the electrical infrastructure specifically because the surrounding economic case doesn't pencil out on its own yet, and the goal is to prove out the corridor before private capital fully believes in it. In both cases, the person swiping a credit card at the charger is subsidized by, or secondary to, a customer who isn't standing at the charger at all.
Nowhere is that dynamic more visible or more strange than in the story of the largest non-Tesla charging network in the country. It wasn't built because someone ran the numbers and decided charging stations were a great business. It was built because a company was ordered to. Case study: the charging network that started as a punishment. In 2015, Volkswagen was caught installing software in nearly 500,000 diesel vehicles designed specifically to cheat U.S. emissions tests, engines that, on the road, released pollution levels dramatically above what regulators allowed. The scandal became known as Dieselgate, and it triggered one of the largest corporate settlements in automotive history. As part of that settlement with U.S. and California regulators, Volkswagen was required to spend $2 billion building out zero-emission vehicle infrastructure and promoting EV adoption nationwide, split roughly between a national investment and a dedicated program in California. Volkswagen's response was to create an entirely new company, Electrify America, to spend that money and build a fast-charging network, one explicitly required to operate as an independent entity and to support vehicles from every automaker, not just Volkswagen's own. Notice what that means for the business model from day one. Electrify America wasn't founded to be profitable. It was founded to spend $2 billion by a court-ordered deadline as atonement for a crime. That single fact explains almost everything that happened next. Within a few years, Electrify America had built thousands of fast chargers, becoming the second-largest charging network in the country behind Tesla. From the outside, that looked like rapid, successful growth. But because the company's core incentive wasn't revenue per station, it was deployment speed and geographic coverage, less pressure existed to keep every charger in flawless working order. Reporting has documented a pattern of reliability complaints, chargers that simply didn't work when drivers arrived, becoming widespread enough that advocates began calling it a second scandal layered on top of the first. A network built to repair Volkswagen's reputation was, for a meaningful share of drivers, damaging trust in EV charging as a category altogether. Now the deadline that created the network is arriving. The settlement funding was structured to be spent over roughly a decade, and as that runway runs out, Electrify America has to answer a question that ordinary charging companies had to answer from day one. Can this actually stand on its own economically? Recent industry analysis has flagged real expiration risk, the possibility that some of this settlement-funded infrastructure ends up underused, without continued outside support, because it was never built against the same profitability test that a private investor would have demanded upfront. Electrify America is an extreme example, a company whose original customer was a court, not a driver. But the underlying lesson applies far more broadly across the industry, and the numbers from the companies that were built purely as businesses tell an almost identical story. The purely commercial operators aren't doing any better. ChargePoint, EVgo, and Blink are the closest thing the U.S. has to pure-play, publicly traded charging companies, businesses built from the ground up specifically to make money running charging networks, without a settlement or a car company subsidizing them. In 2024 alone, those three companies posted combined net losses exceeding $600 million. ChargePoint went through repeated rounds of layoffs and a CEO change as its stock lost the large majority of its value.
EVgo needed a federal loan guarantee exceeding $1 billion to keep expanding its footprint.
Meanwhile, Tesla, which builds and operates its own proprietary supercharger network primarily to sell more Tesla vehicles, not to run a standalone charging business, has been adding new fast chargers faster than every competitor combined, at times accounting for close to half of all new fast charging ports installed nationwide in a single quarter. Tesla doesn't need its charging network to turn a profit on its own terms, because the network's real job is making Tesla ownership more attractive. That's the same logic playing out again. The entity funding the infrastructure isn't primarily trying to profit from the person plugging in. This is the pattern across the entire industry, told from 3 different angles: a settlement-funded network, venture-backed pure plays, and a car manufacturer's proprietary system. In every version, the charging station itself struggles to justify its own existence purely on driver payments. It survives because something else, brand strategy, government policy, real estate traffic, legal obligation, is willing to absorb the gap. So what does ownership actually look like if you're the one signing the loan? Strip away the settlements and the car company subsidies and picture an independent owner deciding whether to build a station today. In the best case, the site sits on a high-traffic corridor with genuinely scarce charging competition nearby. The utility connection is cheap because adequate power already runs close to the property. Government incentives offset a meaningful share of the installation cost, and EV adoption in that specific region keeps climbing steadily enough that utilization improves every year. Under those conditions, a station can become a real durable business, closer to owning well-located real estate with a long-term tenant than a fuel retailer. The realistic outcome sits well below that. Margins stay thin for years while utilization slowly climbs. The operator absorbs demand charge volatility as the biggest ongoing risk on the books, and profitability depends heavily on secondary revenue, retail partnerships, advertising, government or automaker payments, rather than the charging fees themselves ever fully covering the bill. And the failure case is the one that shows up quietest, spread across the industry rather than concentrated in a single dramatic collapse. A station in a mediocre location, built with financing that assumed faster EV adoption than actually happened, where demand charges consistently outpace revenue, maintenance gets deferred to protect thin margins, reliability slips, and the site slowly becomes one of the broken charger data points showing up in driver apps, quietly discouraging exactly the EV adoption the whole industry is depending on to eventually make it profitable. That last outcome is the real irony sitting underneath this entire industry. Charging infrastructure has to exist before EV adoption is high enough to make it profitable. Someone has to build ahead of demand. But building ahead of demand is precisely what triggers the demand charge problem, the utilization trap, and the reliability spiral that can undermine the very adoption the infrastructure was built to support. So, go back to the assumption you probably started with: an EV charging station as a modern gas station. Cars in, money out, powered by a wave of adoption that's already underway. What it actually resembles is something closer to a small, privately financed piece of public utility infrastructure wrapped in a retail storefront, built years ahead of the demand curve, billed by capacity rather than by sales, and kept alive far more often by automakers, governments, and real estate strategy than by the driver standing at the plug. The charger is the part everyone sees. The part that actually decides whether the business survives is the wiring, the utility contract, and the question of who, besides the driver, is willing to keep paying for the gap.